Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Service International Limited. Here's your daily technical analysis of foreign exchange markets. I'll start with the euro against the dollar. A bullish white soldier yesterday as the market restarted its recent rise, but in a more considered fashion. This was because over the last week and a bit, the market had punched up and closed over some considerable resistances. Most recently, the declining middle time, currently at 106.85, or the well-highlighted January to May 2021 bearish Andrews pitchfork, and the April 2020 low at 107.25. These are now supports. Yesterday, the market punched up and closed over both the next significant piece of resistance, the combination of May 2020 low at 107.66, and the declining short-medium moving average, currently at 107.59. This moving average is important, as I would only ask you to look upwards on the daily chart at the last time the market approached the short-medium moving average back at the end of March, and the resultant move lower that happened. It will now be interesting to see if the market makes its own way this time, or if it will repeat what happened back in late March. The next overhead resistance is the February to date downtrend, currently at 108.01, though this is only a 2-pointer. And then we're in a free area until we meet some of the highs of April at 109.23, 109.36 and 109.50. Meanwhile, further below, the next support is the 2020 low at 106.35, but the better support starts from the April 17 low at 105.68 and extends lower thereafter. So far today, well, a reactionary move back down today, currently testing the April low at 107.25 and looking like a combined bearish opening Black Mariposa and bearish engulfing pattern, if only just on the latter. Cable, aka sterling against the US dollar. A fourth bullish white soldier yesterday as the market rose once again towards the overhead resistances at 126.72, the September 2020 low, and 126.86. However, the market held off testing it properly. This was a continuing follow-on high to the recent immediate countering bullish harami. The market is still within the free area between the congestion zone below between 124.78 and 125.09, which contains the 38.2% Fibonacci of the March 20 to June 21 move at 124.89. Meanwhile, above we have these resistances at 126.72 and 126.86. We also have the high from 3 weeks ago in the 126.35 area in between, but I'm minded not to reference that too much right now. So far today, well, a reactionary move back down today as the market, for now, has given up testing on the overhead resistances at 126.72 and 123.86, and instead started to form a possible bearish engulfing pattern right now, maybe even a bearish double. Euro sterling. Yet further intraday indecision today with a third countering bullish, yesterday, with a third countering bullish double after the previous session's counter to the counter bearish harami and the earlier immediate countering bullish harami, if only just on that one. It still seems the market is not yet done with the pipe top stroke possible double top formed early last week. So, that being said, just below the current levels we have support from the following, the April 21 low at 84.70, the broken 21 to date downtrend currently at 84.66. That makes up the upper trend line of the extended diamond pattern. The flatlining long moving average currently 84.41, the upper trend line currently 84.09 of the smaller, more robust lopsided diamond pattern, and finally moving up and into the frame the short medium moving average currently 84.17. For the moment, we still have on the upside for the smaller lopsided diamond pattern a primary target X in the 86.80 area and a harder secondary target X1 in the 87.65 area. And for the extended diamond pattern, we have a primary target X2, and that's in the 87.15 area, and a harder secondary target X3 in the 88 even area. Additionally, there is also the one final pattern, and it is a big one, which this market had previously triggered but then sent mixed messages on. I've spoken for weeks now, months even, of a very large falling wedge pattern, currently 84.66 to 81.56. This pattern is still in operation, but it has fallen into the shadows a little with the rising prominence of the diamond patterns. And though triggered, this pattern still leaves us with some questions. You see, it has the most ambitious upside target of all. Target X5 for this pattern is in the 88.65 area. And that really is a very big ask. So far today, well, nothing much, a slightly higher than high than yesterday, and also a dip below yesterday's close, but not exactly looking anything other than potentially either indecisive or a bearish reactionary pattern. So that will go down to the fourth countering pattern if it does, but we'll see. US dollar against the Indian rupee. An interesting hammer pattern yesterday as the market dipped below the May based uptrend, currently at 77.55, but ended up closing right on it, though with what is predominantly seen as a bullish pattern. Overall, the market is still within the new congestion zone between 77.40 and 77.80. However, as stated yesterday, there seems to be a possible new element in the mix. You see, whilst the market is overall still in between the lower time below, currently at 77.21, and the middle time above, currently 78.67, and that's of the mid-January to early April bullish Andrews pitchfork. And we still have overhead target X in the 78.30 area. This is the potential target for the whole of the 22 action being a possible bullish halfway hesitation. You see, with all these big picture patterns, we should not overlook something growing at our feet. And by that, I mean that the last 3 weeks action does have elements of a horn top, as well as elements of a possible ascending triangle pattern. These are not fully developed patterns as yet, just actions that have elements of these patterns. Hence, I will ponder on these a little more as the market continues to seemingly trying to make up its own mind about what's next. So far today, we're a slightly lower open, just below the uptrend, but an immediate move back up over the uptrend, and looking right now like a combined bullish engulfing pattern and bullish opening white Mariposa. US dollar against the Brazilian real. A hammer pattern yesterday. I suppose it's not that surprising, as the recent fall in the market had seen the move down be eroded by congestion under the overhead short medium moving average, currently at 485 even, from levels at 484.26, and that's the 50% Fibonacci line of the June 2019 to May 2020 move, plus the June 2020 level at 81.62, as well as the 477.54 level, the 50% Fibonacci line of the October 18 to May 20 move. All these are now resistances. Then Friday and yesterday, the market tried tackling the heavily marked congestion at 472.90 to 472.92. And though prices dipped below there, as well as the next support of 471.42, the market failed to consolidate the move lower and made its first bullish pattern for nearly 2 weeks. This doesn't mean that the move lower is over, but it does show a rest period for the market. Overall, we are still in between the upper time, currently at 506.77, and the middle time, currently 460.57, of the start of 2022 to date, bearish Andrews pitchfork. This is still an early development bearish pitchfork, but it may have some merit in forming and hence showing the recent bearish angle of attack. And it'll be interesting to see what happens if and when the market approaches the middle time below. US dollar against the Mexican peso. Another significant action yesterday. One could say it was the fifth bearish black crow in a row, but that is not the picture. Nor calling it a type of indecisive spinning top. No. It was a hammer pattern, usually seen as a bullish pattern, which saw the long tail reach down and properly fulfill target X in the 1954 area for the late April to early May cat's ears pattern. Then dropped below the 2021 low at 1953.63, as well as the middle time, currently 1951.95 of November 21, March 22, bearish Andrews pitchfork. It was at that point I suspect the market realized that though it was bearish as a market, it was not that bearish, and thus closed back up over the middle time. This has left me wondering if the market really wants to move lower, other than along maybe traveling along the middle time lower. And so far today, well, indecision as the market sits on top of the 2021 low and the declining middle time. We're now on the edge of a fairly free area below, all the way down to some dubious congestion support at 1915. It'll be interesting to see if the market goes for it and how it does it. Target X, having been fulfilled, will now be retired. Thank you for listening. This short version broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyrights Eddie Tofpik and ADM Invest Services International Limited. And here comes the final bit.